SG&A. Looking at a detailed view of the quarter, Macy's Inc. net sales of $4.7 million, or about $29 million to last year. The sales decline was entirely attributable to the 64 non-go-forward stores that closed at the end of last year. These contributed roughly $160 million to sales in the year-ago period. Excluding the impact of these planned closures, Macy's Inc. sales grew 2.9%. This represents an acceleration from second quarter sales growth of 0.9% when similarly adjusted for closed stores. By nameplate, Macy's net sales were down 2.3%. Macy's comparable sales were up 2%, while go-forward comparable sales continued to outperform, rising 2.3%. Reimagine 125 comparable sales rose 2.7%. Both the first 50 and the next 75 locations achieved another quarter of positive comparable sales results. Net Promoter Scores at these locations continued to exceed the broader fleet. In luxury, Bloomingdale's net sales rose 8.6% and comparable sales were up 9%. And Bluemercury net sales were up 3.8% and comparable sales were up 1.1%. Turning to revenue, total revenue was $4.9 billion. Other revenue, which is comprised of credit card and Macy's Media Network, was $200 million. Within that, credit card revenue was $158 million, or $38 million higher than prior year. Credit card revenue continued to be driven by our healthy credit portfolio and the prudent management of net credit card losses, as well as growth in new applications. Macy's Media Network revenue was $42 million, roughly flat with the prior year. Gross margin was $1.9 billion, or 39.4% of net sales, compared to 39.6% last year. Excluding a 50 basis point tariff impact, gross margin rate would have expanded approximately 30 basis points. The third quarter tariff impact was lower than anticipated, as mitigation actions performed well. This led to a better-than-expected gross margin rate. Traffic was positive, and AUR continued to increase, primarily due to a favorable mix shift and positive customer response to newness across classifications. SG&A expense of $2 billion declined $40 million from last year, reflecting the net benefit from our closed Macy's locations and continued cost containment efforts. This was partially offset by ongoing investments in our go-forward business, which we view as imperative to driving healthy and sustainable top-line growth. As a percent of total revenue, we levered SG&A expense by 90 basis points to 41.2% compared to 42.1% in the prior year, benefiting from revenue growth, diligent expense management, and a modest shift in timing of expenses. During the quarter, we recognized $12 million in asset sale gains. This compares to our expectation of $20 million and $66 million last year. We remain committed to closing underproductive stores and are being disciplined with our approach to transactions. The strength of our balance sheet provides us with the patience and flexibility to ensure we are achieving the best value. Core adjusted EBITDA, which is adjusted EBITDA excluding asset sale gains, was $273 million, or 5.6% of total revenue. This was above our guidance of 3.3 to 3.7% and last year's result of 4.2%. Adjusted EBITDA was $285 million, or 5.8% of total revenue, compared to 5.6% last year. Third quarter adjusted EPS of 9 cents was also well above our guidance of a loss of 15 to 20 cents and compared favorably to 4 cents last year. Inventory dollars were up 0.7% to last year, in line with our expectations, reflecting tariff-related cost increases. On a unit basis, inventories were down, and we are well positioned for holiday. We continue to take a disciplined approach to our cash flow and balance sheet. Year-to-date operating cash flow was $247 million versus an outflow of $30 million last year, and free cash flow was an outflow of $183 million versus an outflow of $492 million last year. Capital expenditures were $525 million, down from $649 million spent last year, and monetization proceeds were $95 million compared to $187 million last year. We returned $350 million to shareholders through $149 million of consistent quarterly cash dividends and $201 million of share repurchases, including $50 million of buybacks in the third quarter. This leaves approximately $1.2 billion remaining on our buyback authorization. And we ended the quarter with $447 million of cash on our balance sheet compared to $315 million last year. Turning to end-to-end operations, we continue to improve our network and make strategic investments to increase speed of delivery and reduce costs. We believe further opportunity remains with the recent opening of our new customer fulfillment and store replenishment center in China Grove, North Carolina. Outfitted with the latest automation solutions, it is the company's largest and most technologically advanced distribution center. I want to thank our supply chain and broader teams for this tremendous accomplishment. Positioned in the Southeast, the 2.5 million square foot facility expands our reach, enabling faster, more efficient service for millions of customers. By supporting all product categories, from apparel and beauty to home and toys, more orders can be shipped from a single location, helping customers receive everything they need faster and in fewer boxes. The China Grove facility is initially supporting customer fulfillment and store replenishment for the Macy's nameplate, with plans to expand to additional nameplates. Now I would like to turn to guidance. We entered the fourth quarter well-positioned. We are confident we have a compelling mix of categories and brands across a variety of price points to satisfy our customers' holiday needs and wants. These are supported by exciting marketing campaigns, events, and experiences designed to activate and engage customers. As Tony mentioned, we are pleased with the start of the fourth quarter. With the majority of our sales volume still ahead, our guidance continues to incorporate a more choiceful consumer, assumes that the current tariffs remain in place, and provides flexibility to respond to changes in consumer demand and the competitive landscape. For the fourth quarter, we expect net sales of approximately $7.35 billion to $7.5 billion. As a reminder, last year's store closures contributed about $200 million to sales in the comparable period. Comparable sales to be down approximately 2.5% to flat, with go-forward comparable sales down 2% to flat. Core adjusted EBITDA as a percent of total revenue of 9.4% to 10.1%, and adjusted EPS of $1.35 to $1.55. We are now expecting fourth quarter asset sale gains of roughly $15 to $20 million, compared to our prior expectation of $38 million. This impacts fourth quarter adjusted EPS by approximately 5 to 6 cents relative to our prior expectation. Based on fourth quarter guidance, our revised full year 2025 guidance assumes net sales of approximately $21.475 billion to $21.625 billion. As a reminder, fiscal 2024 store closures contributed roughly $700 million to net sales. Comparable sales to be flat to up 0.5%, with Macy's Inc. go-forward comparable sales to be flat to up roughly 1%. Other revenue of approximately $830 to $840 million, with credit card revenues expected to be roughly $635 to $645 million, and Macy's Media Network to be approximately $195 million. Gross margin as a percent of net sales to be 37.7% to 37.9%. This is better than our prior expectation, reflecting effective tariff mitigation efforts, including shared cost negotiations, vendor discounts, and strategically raising tickets. We now estimate a 40 to 50 basis point tariff impact to gross margin, which equates to roughly 25 to 35 cents of EPS. This is below our prior expectation of 40 to 60 basis points and 25 to 40 cents of EPS. SG&A to be down low single digits on a dollar basis to last year, with fourth quarter dollars also down low single digits. As we maintain our disciplined approach to expenses, we will continue to invest in areas that are contributing to our growth profile. Asset sale gains of about $60 to $65 million, compared to our prior expectation of $90 million, and $144 million last year. Core adjusted EBITDA as a percent of total revenue of 7.5 to 7.7%, and adjusted EBITDA of 7.8 to 8%. Interest expense of roughly $100 million, reflecting our recent financing transactions. And finally, we have raised our expected adjusted EPS to $2 to $2.20. The previously mentioned change in asset sale expectations has a roughly 7 to 8 cent impact on annual EPS relative to our prior guidance. Our guidance does not include additional share buybacks. In conclusion, we are encouraged by recent results. We have a healthy balance sheet, including ample liquidity and a disciplined capital allocation strategy. We remain committed to thoughtfully navigating the near term as we execute against our long-term goals. Now, let me turn the call back to Tony.
Thanks, Tom. Changes come to Macy's, Inc. We are giving our customers even more reasons to shop with us. I encourage you to visit our stores, our website, or the apps. The difference from when we first embarked on the Bold New Chapter 20 months ago are palpable. The strategy is gaining traction, and our teams across nameplates are energized and fully committed to delivering long-term growth. And with that, operator, we're now ready for questions.
Thank you. We will now be conducting a question and answer session. If you would like to ask a question, please press star 1 on your telephone keypad. A confirmation tone will indicate that your line is in the question queue. You may press star 2 if you would like to remove your question from the queue. For participants using speaker equipment, it may be necessary to pick up your handset before pressing the star keys. Please limit yourself to one question and one follow-up question. One moment, please, while we poll for questions. Our first question is coming from Matthew Boss of J.P. Morgan. Please go ahead.
Great, thanks, and congrats on the improvement.
Thanks, Matt.
Tony, with 2 straight quarters of positive comps, could you speak to traction that you're seeing with your reimagined store initiatives as it relates to traffic versus basket? And could you elaborate on November comp trends and customer behaviors that you're seeing maybe relative to the third quarter?
Sure, Matt. Thanks for the question. We're definitely seeing traction in the R125. That's positive growth in both the first 50 and the next 75. That sequential improvement at 2.7% comp. It's a reaction, I think, of customers to new brands, to better presentation, to more colleagues in the right place at the right time. We've seen consistent traffic in our stores and in the digital business, frankly, and continued improvement in AUR. So we come out of the third quarter, and as we said, the fourth quarter pleased so far, but we obviously have a very big part of the fourth quarter in front of us. So we're taking that choiceful approach to this aspirational customer that shows up in force to the latter part of the fourth quarter. So we just had an echo in here, apologies. So just wanted to make sure that the guidance obviously is not a ceiling. It's intended to show the guardrails of how we're thinking about the business. And we come out of the month of November, as we came out of the third quarter, confident in our strategy.
Thank you. The next question is coming from Brooke Roach of Goldman Sachs. Please go ahead.
Good morning, and thank you for taking our question. Tony, what are the most important drivers in the business that you think can sustain the momentum as you look ahead into 2026? As you continue to execute the Bold New Chapter strategy, how are you thinking about the opportunity for core adjusted EBITDA margin delivery? Do you see the recent tariff margin pressure as recapturable into 2026? Thank you.
Thanks, Brooke. Appreciate the question. The drivers of the business are not unlike what we've been talking about. It's having the right product assortment that is less redundant and more variety. It's having the right balance of good, better, best across the entire matrix of our assortment. It's having the right balance as an omni-channel retailer of having a good physical business and a good digital business, which, by the way, we had a good digital business and a good physical business across all 3 nameplates. It's making sure that we shed underproductive stores, which, again, when you look at the third quarter comp, you don't have $170 million of closed store volume in that number, which is why the go-forward comp is so important to measuring our performance quarter to date, year to date, and what we've guided for the fourth quarter. In terms of core EBITDA, I'm really pleased with the core EBITDA result because if you look at the shortfall in asset sale gains, our performance is better than a year ago and better than our guidance. And it's better than a year ago with $170 million less in sales. Same is true for the fourth quarter. So I look at the opportunities being navigate the tariffs. They don't go away, so they are a part of how we have to operate in 2026 unless something changes with the courts. And we have the ability as a multi-channel, multi-category, multi-brand, multi-price point retailer to offer the customer what and where and how the way they want to shop. I think this is a perfect opportunity for a department store to lean into what we're very best at, which is offer a broad range of assortment and not let the tariff impact get in the way of our comp performance.
And Brooke, I'll add in here, when we look at our full year guide, which we were really pleased to raise as we beat Q3, we're now in a range where we're equal to where we were at the beginning of the year, and that's with a tariff impact of 25 to 35 cents built in and a slightly lower ASG around that 7 to 8 cents. So